Hello, universe. Welcome to our series of videos showcasing some examples of how we trade with our custom pinescript strategies and indicators. This is part one of the series we will be releasing, and I thought I would start with our advanced decline MACD combination updated for V5. The way we like to use this is, and there are multiple different options here that you can change and calibrate to your particular needs. But we like to take a top-down multi-time frame approach on this, and we like to trade with the prevailing momentum, essentially. So what do we mean by that? Well, obviously it starts at the highest time frames and it goes all the way down. We clearly broke out of the bear market from the 2022 crash and have re-entered a new bull market. So on the higher time frames, everything is bullish. Now we can get these reversals and go from overbought to oversold. We have these dips, which are tremendous buying opportunities in our opinion. And again, this is all just for educational purposes. Nothing should be construed as financial advice. This is just an example of how we trade with our indicators. And as I was saying, we take a top-down approach, right? We will sometimes trade against the prevailing trend, but with a very tight leash. So one of the ways we use this is as follows. As you can see from the slides I've been showing you, we have a bullish trend. And one interesting thing to note about this strategy is you can see its returns, its profit factor diminish on higher time frames. So we like to trade actually with the lower time frames, but we still use a top-down approach to make sure we are either going with the prevailing trend or have a really tight leash when we're not. So, as you can see, as we go down in time frames, we hit a sweet spot of profitability and percent profit. I'm not as concerned with percent profit. Sorry, I misspoke. I meant net profit. I am not as concerned with percent profit as long as we have a positive profit factor. So what does that mean? So this strategy only wins about 36% of the time, right, on this time frame with these settings. But it has a 1.85, let's say, profit factor. So what does that mean? It means even though it loses about 2/3 of the time, when it wins big enough to more than make up for that. A profit factor of 1 would be break even. Anything below 1 would be a losing strategy, right? You can see here the net gains that this has made. This is with a $1,000 account, trading one contract of the S&P 500 or the SPY ETF. So what I've done for you is taken an example from this past week. Happy 4th of July to my fellow Americans out there. Happy Independence Day. Hope you all are having a good one. So earlier this week, we were presented with an interesting opportunity. And so this is what it looked like on the half-hour chart. You've already seen the higher time frames, right? So we're able to break this down, and like I said, you can see the different results on the different time frames. So that's the half hour. I have the half hour here, the 20-minute there, the 15-minute here, and we go all the way down from the 15 down to the 10 down to the 5. So let's see how this trade ended up manifesting. This is on July 1st, which would have been Monday. And this is at the end of the day on Monday. So the trade actually presented itself Tuesday morning. And I'll play the bar replay and I'll see if I can kind of try and sync this up across the time frames. Although, obviously it's not going to sync perfectly because, there's 3 5-minute bars and one 15-minute bar, right? So, but I think you should be able to see what I'm talking about. So we'll start on the 5. Oh, my bad. The 5. So there's Tuesday morning. Right? And we have positive momentum on the MACD, positive accumulation distribution on both of the differently set AD parameters. This is on the 5-minute. On the 10-minute, there's the start of Tuesday, the 2nd. We have the same thing, positive MACD momentum, positive accumulation distribution. The 15-minute had positive MACD momentum from Monday the 1st, the day before, and the accumulation distribution just turned positive. You can see it gave the long signal here, right? At the close of this, or actually it was starting to flip here, right? So these are the indicators, and this strategy waits for the close of the previous bar, which happened at the very last 15-minute candle of Monday the 1st. and everything was still intact Tuesday morning, so it gave the long signal here at 5:43.77-ish. Now, if we wanted further confirmation, right? We have the 20-minute. Could have entered anywhere in this zone. And we have the 30-minute presenting shortly. And there we go. And now we have confirmation on 1, 2, 3, 4, 5 different lower time frames. Plus, if we wanted even higher time frame confirmation, we would have had to have waited till here, which would have been, this is Central Standard Time, these charts around, so this would have been 9:30 in the morning. That would have given the entry here, right? Because the strategy, the way this is set up, is currently, those are the inputs. It's looking for agreement between 3 of the conditions for entry into a position, long or short, and it's looking for 2 for an exit. So it exited, it's short here for a small loss, and it entered long there. And we can watch it play out on all of the different time frames. And let's see what happened. We have to wait for the 5 minutes to catch up. Wait for the 5 minutes to catch up. If I can get these to work right. And let's jump over here just for comparison. See how this looked. I'm 20 and 30-minute time frames. and that is the close of Wednesday, July 3rd. Because it was a holiday, the markets closed at noon Central, essentially. Or, yes, that's correct, noon. And you can see what this ended up doing, right? So it took the trade from about, let's call it 544.75 up to 551. So that is about a $6.50 move. So you might be thinking, okay, well, that doesn't seem that great, right? But we trade options. And so what does that translate? We don't only trade options, but we do trade options. So what does that translate to? Here you can see this is the 550 call expiring Friday, that's tomorrow, July 5th. And at the opening where this trade began on Tuesday, July 2nd, these contracts were trading for about, $30, $40. And during the course of this 2-day trade, with an options contract expiring 4 days out, including the market being closed for essentially 1.5 days for the holiday in that 4-day period. So you have to take the Greeks into account. But in this day and a half, 2 days of trading with this system, this contract went from, let's call it $40 to a high of $265. Let's say you wanted to close the position and not eat the theta from the day and a half of the holiday and not hold it into expiration, and you close, let's say, somewhere around here. Maybe you were looking at the 5-minute chart and MACD was making you nervous, or looking at any number of other things, maybe not even these charts, maybe something else. So let's say you made 220, you sold the contract for 220, minus the 40 for the initial investment, so you made $180 on a $40 investment. So divided by 40 times 100, that's 450%. That's trading with EMCS.